In problem 14-2, we've been given an income statement, a comparative income statement, and a comparative balance sheet, and we've been asked to prepare various ratios for 2017. The first ratio we've been asked to prepare is the earnings per share number, and this number is basically your, we'll start out with the formulas over here, as I explained, is your net income divided by average shares outstanding. So this is the only non-dollar amount number you're going to see in all the ratio analysis we do in this particular problem. So basically saying the net income that's earned, if it was distributed to all the shareholders that were outstanding, how much would each of them get? Okay, we're not giving them the number, but we're just saying what the performance was. So we know that the weighted average shares outstanding was 57,000. And we know in the problem the net income is 203. It's given to us. Both the numbers are, all the numbers are given over here. Okay, so 203 divided by 57 gives you earnings per share of $3.56. So saying for, basically saying for each shareholder, the company in the current year had a net income earnings of 3.56. This number in isolation is meaningless. When you compare it to the year before and the year before that, you will see the trend and you will see whether the number is growing or not. Obviously, everyone wants to see the earnings per share go up. No one wants to see the earnings per share number go down. The next is return on equity. Return on equity is calculated as net income divided by average total equity. Net income again is 203. The equity is, average equity will be these two numbers, 566,700 plus 465,400 divided by 2. That will be the average equity number. Oops, just went off in the wrong direction there. Okay. So 203 divided by 516,050, and again that number is calculated as the equity numbers, the two total equity numbers that you have, add the two and divide by 2, and that is going to give you your average number, and that says return on equity is 39.34. Return on assets is calculated as net income divided by average total assets. So net income is the same number, 203. Average total assets is calculated as the total assets in 2017 plus the total assets in 2016 divided by 2. And that number works out to 22.27. Just looking at these numbers, they're good, but again, you need to see compared to the year before what they look like. Current ratio is easy. It's current assets divided by current liabilities. They've told us what the current assets are, the total current assets for each of the years, as well as the current liabilities. So you just need to plug in those numbers, and typically we are looking at a 2:1 ratio is considered to be a very healthy number. This is certainly from the perspective of the vendors and suppliers. A lot of companies will say not necessary, especially if they don't have too much in inventory or prepaid expenses. Then a 2:1 ratio is not necessary. So let's move down to the asset test ratio. You want quick assets divided by your current liabilities. So in the quick assets, which one are we going to eliminate over here? So it has to be close to cash. Cash obviously is cash. Short-term investments, I sell it and I can make it cash. Receivables, I need to collect and make it cash. So those are all quick assets. Inventory is not a quick asset. I need to sell it. Perhaps it'll become a receivable and then I need to collect it. So I exclude that. Based on that, what happens to my ratio? It drops to 1.16. It's still a 1:1 ratio is considered to be a healthy ratio, so we're fine over here. Accounts receivable turnover is calculated as net sales divided by average accounts receivable. This is basically how quickly I'm moving my receivables and converting it into cash. So it's almost it's 17 over here. Accounts receivable, the next one you're concerned with is the inventory turnover. So going through this, it's cost of goods sold divided by average inventory. So you're moving inventory 8 times a year. And just a note over here in terms of how quickly a company could expect to move their inventory. It depends on the type of merchandise you're selling. For retail businesses, for high-end dealers, for companies selling high-end products, the inventory turnover number is not going to be a very high number. It's going to be a rather low number. So all your jewelry stores, car dealers, they don't sell that much in volume. What they do is whatever they sell, their markup is extremely high. As an extreme example, the dollar store, they have to move their merchandise almost on a daily basis. If they can't move their inventory very, very quickly, they're just going to shut down because their margins are extremely low. It's the volume that's going to make their business. So they have to sell a lot. So again, 8.1, it depends on what type of business this is. Okay. Now this next ratio is interesting in that we are looking at times interest earned. Let's go to the income statement for this. In the income statement, let's look over here. My interest expense is 87,000. The question is, do I have sufficient money to pay that? So obviously I'm looking at the number above it. Okay, so that number is frequently called in finance EBIT, EBIT, that's earnings before interest and taxes. Okay, so I'm looking for the number that I have before interest expense. Okay, so what do I have above interest expense? That's the number I'm looking for. 308. In this case, it's income from operations. I subtract interest, I subtract taxes to get the net income number. That's the final earnings number. So the earnings number that I have before the interest and tax is the number I'm concerned with. So you can just eyeball it and say, obviously, we are in a very good position to pay off the interest expense. 17.1 times. Obviously, a very, very healthy number. The reason this is very important is if you have long-term borrowings, some of those lenders may have put certain rules that you should always have the times interest earned ratio to be 3, 4, 5. They can come up with some number and say, if you don't have that number, we reserve the right to, and to do what? X, Y, and Z. They can raise the interest rate. They can basically put a chokehold on you for various things. So this is a real concern if you have liabilities. Liabilities where you have to pay interest. Okay, let's look at asset turnover. Asset turnover is net sales divided by average total assets. The net sales number is the top line number, 18,500. Average total assets is going to be your total assets for 2017 plus total assets for 16 divided by 2. And here we have, it comes out to an even 2 asset turnover. And finally, we have the debt to asset ratio, basically saying for every asset, every dollar you have in assets, how much of that is financed by liabilities? Okay. So let's look at this last number. It's 41.59, almost 42%. Basically saying for every dollar you have in assets, 42 cents is borrowed money. The higher the number, the higher the leverage. In finance, we use the word leverage. So if you say a company is highly leveraged, it means that company has a lot of liability. Most people in finance will tell you 60% is a dangerous number. Anything above 60% is extremely risky. That's basically saying more than 60% of your business is being financed by liabilities. And that's typically when things start going south very rapidly. If something changes in the economy, you're going to be in a lot of trouble very quickly. And if you look at a lot of the Fortune 500 companies, you'd be surprised which ones have a very high leverage. It's typically the older companies, the manufacturing companies. They are very, very heavily leveraged, which means uh, they're basically at the mercy of the big banks that hold all those debts that they have. So again, this problem should give you a good idea as to how you do the ratio analysis and what it means. And that's really more significant than doing the numbers just as we did over here. Doing them in Excel obviously is a lot simpler. When you do this in Wiley Plus, please make sure you enter information correctly as has been asked in the Wiley Plus specific problem that you're doing.